Financial Intelligence by Karen Berman and Joe Knight. Picture this. It's the late 1990s, and Wall Street has a superstar they've nicknamed Chainsaw Al. His real name is Al Dunlap, and he's got this incredible reputation as a corporate miracle worker. Whenever a struggling company brings him on as their new boss, something magical happens. Their stock price skyrockets, sometimes jumping 50% the very day they announce he's coming aboard. His approach? Absolutely ruthless. But from where investors are sitting, it looks like pure genius. He swoops in, fires thousands of people, shuts down factories left and right, and cuts costs down to nothing. And just like that, profits magically reappear on the company's financial statements. So in 1997, he takes the reins at Sunbeam, the appliance company. True to his reputation, he immediately cuts the workforce in half. Profits shoot up, Wall Street goes wild, the stock price goes absolutely through the roof. But here's where things get interesting. Dunlap has a problem on his hands. His real endgame is to sell the company and walk away with a massive payday, but now there's a catch. The stock price has climbed so high that no one can actually afford to buy the company anymore. He needs to make Sunbeam look even more profitable to justify that sky-high price tag. So his team does something really bizarre. Right in the middle of winter, they start calling up major retailers like Walmart and Kmart with an offer. They convince these stores to buy enormous quantities of summer barbecue grills. The kicker? The retailers don't have to pay until spring arrives, and Sunbeam will even store all those grills in warehouses for them. It's a clever accounting maneuver called bill and hold. And just like that, Sunbeam gets to record millions of dollars in sales immediately, making their fourth quarter numbers look absolutely spectacular. To almost everyone watching, it looked like brilliant business strategy. But one analyst, a guy named Andrew Shore, had this nagging feeling that something wasn't quite right. He didn't have some inside source feeding him secrets. He simply sat down with the company's public financial reports and started doing some math. He calculated one simple ratio, something called days sales outstanding, and what he discovered made his jaw hit the floor. The number was enormous, way higher than it had any business being. It was like spotting a single loose thread sticking out from what looked like a perfectly woven tapestry. But when he gave it a tug, the whole thing came unraveling. He realized Sunbeam had essentially borrowed sales from the future to make today look amazing. He downgraded the stock, the story exploded into public view, and the company eventually crashed into bankruptcy. What if you could see what that analyst saw? What if someone handed you the key to unlock what financial numbers really mean? That's exactly what we're diving into today with Financial Intelligence by Karen Berman and Joe Knight. This isn't some dry textbook written for accountants. It's a guidebook for the rest of us. It shows you that finance isn't really a hard science at all. It's an art form. And by the time we finish this journey together, you'll understand the fundamentals of this art, and you'll have the tools to look at any business, including your own life and career, with fresh, powerful, and revealing clarity. We all grow up with this deep belief that numbers are the one thing we can absolutely trust. They're black and white, completely objective. 2 + 2 always equals 4, right? But here's the thing. In the business world, that's not quite how it works. Karen Berman and Joe Knight reveal something that financial professionals have always known, but the rest of us often miss. Finance and accounting are just as much art as they are science. That's the big secret hiding in plain sight. The numbers you see on a financial report aren't actually reality itself. They're more like a reflection of reality. And just like any reflection, it can be shaped, adjusted, and sometimes even distorted. Think about the people creating these reports, the accountants and financial officers. They're making educated guesses all day long. They have to estimate how many years a new piece of machinery will last before it needs replacing. They have to predict what percentage of customers probably won't end up paying their bills. They have to decide how to categorize certain costs. None of this is necessarily dishonest or shady. It's just the nature of trying to capture a complex, messy business reality in a neat set of numbers. But every single one of these assumptions and estimates introduces what's called a bias, a slight tilt in one direction or another. Financial intelligence, at its heart, is the ability to spot that bias, to understand where the numbers are solid and where they're more flexible, and to ask exactly the right questions. The first illusion we need to shatter, and maybe the most important one, is this idea that profit is the same thing as cash. So many people, even managers at major corporations, genuinely believe this. If a company's profitable, it must have tons of money in the bank, right? Not even close. This is lesson number 1 in financial intelligence. Profit is an estimate. Cash is a fact. You can't pay your bills with estimates. You can only pay them with actual cash. Let me paint you a picture. Imagine you run a simple business. Maybe you sell custom t-shirts. In June, you land this huge order from a local school for $1,000. You buy the blank shirts and the ink. You print them up beautifully, and you deliver them on the very last day of the month. According to accounting rules, you've just made a sale. You get to record that $1,000 as revenue for June. Let's say your costs were $400. You can proudly announce you made $600 in profit. But here's the catch. The school has 30 days to pay you. So on July 1st, when you check your bank account, how much is in there from that big sale? Absolutely nothing. $0. You've got profit on paper, but you've got no cash in hand. This fundamental concept comes from something called the matching principle. All it really means is that accountants try to match the costs of doing business with the revenues they generate in a specific time period. The cost of those t-shirts and that ink gets matched to the revenue from selling them in June. It doesn't matter one bit when the actual cash moves in or out. This one idea, that profit isn't the same as cash, is the key that unlocks everything else, and it explains why even a wildly profitable, fast-growing company can suddenly go bankrupt. They simply run out of actual cash while sitting around waiting for their customers to pay up. To navigate this world of estimates and realities, businesses rely on 3 main documents. Think of them as 3 different camera lenses you can use to look at the same company. Once you learn to read them, you can understand the financial story of any organization. They're called the income statement, the balance sheet, and the cash flow statement. Let's kick things off with the one most people have at least heard of, the income statement. You might know it as the P&L, the profit and loss statement. If financial statements are like a report card, the income statement tells you how the company performed over a specific stretch of time, maybe a quarter or a full year. It always starts at the top with revenue or sales. This is the total value of all the goods and services the company delivered to customers during that period. But right from the start, we run into the artistic side of finance. The big question becomes, when exactly do you get to recognize a sale? The rule says you recognize revenue when the product or service gets delivered, not when the customer actually pays you. But what does delivered really mean? If you're a software company selling a 5-year subscription, have you delivered the full value on day 1? Obviously not. So accountants have to make a judgment call, deciding how much of that sale counts in year 1, how much in year 2, and so on. This is precisely where companies can get themselves into hot water. Remember Chainsaw Al? His bill and hold strategy was an aggressive, and ultimately fraudulent, way of recognizing revenue before it was truly earned. After revenue, the income statement starts subtracting all your costs and expenses. These get split into 2 main categories. First up is cost of goods sold, sometimes called cost of services. This includes all the direct costs of creating your product or delivering your service. For our t-shirt business, it's the cost of those blank shirts and that ink. For a car manufacturer, it's the steel, the tires, and the wages of the workers actually building the cars on the assembly line. When you take revenue minus cost of goods sold, you get your gross profit. This number is absolutely crucial. It tells you the basic profitability of what you're actually selling before you factor in any of your overhead costs. If your gross profit is weak, your business is in serious trouble because you won't have enough money left over to actually run the company. The second category is operating expenses. This is everything else it takes to keep the lights on and the business running day to day. Think salaries for your marketing team, your accountants, the rent on your office space, the electricity bill. One of the most important operating expenses is something called depreciation. This concept trips people up all the time, but it's actually simpler than it sounds. Imagine a delivery company buys a truck for $36,000. They expect that truck to last about 3 years. It would be totally misleading to slap a giant $36,000 expense on the income statement in the very first month. It would make it look like the company had a catastrophic month, when really they just made a smart long-term investment. So accountants depreciate the truck, spreading its cost out over its useful life. In this straightforward example, they'd record a depreciation expense of $1,000 every single month for 36 months. But notice the artistic judgment here. Who decides the truck will last 3 years? The accountants do. It's an estimate. What if they decided it would only last 2 years? The monthly expense would be higher, and the company's profit would look lower. What if they decided it would last 5 years? The monthly expense would drop, and profit would look higher. This isn't just a theoretical problem. Years ago, a company called Waste Management famously boosted its profits by simply deciding their garbage trucks and dumpsters would last longer than they'd previously estimated. It was an accounting trick that helped hide the company's real problems for years. After you subtract all your operating expenses from gross profit, you arrive at operating profit. This is a fantastic measure of how well your core business is actually running, before you factor in things like interest payments on loans and taxes. Finally, after subtracting interest and taxes, you reach the famous bottom line, net profit. This is what's left over, after every single cost and expense has been accounted for. It's definitely an important number, but, as we've seen, it's the result of dozens and dozens of assumptions, estimates, and judgment calls. It is absolutely not the same thing as cash. So if the income statement is like a report card covering a period of time, the second key document, the balance sheet, is more like a snapshot. It's a photograph of the company's financial health on one specific day. The balance sheet is built on a single, elegant equation. Assets equal liabilities plus equity. Let's break that down using your own personal finances as an example. Assets are everything you own that has real value. The cash sitting in your bank account, your car, your house, your computer. For a company, it's the same idea. Cash, inventory, equipment, buildings, and money that customers still owe them, which is called accounts receivable. Liabilities are everything you owe, your car loan, your mortgage, your credit card balance. For a company, it's money owed to suppliers, which shows up as accounts payable, plus bank loans and other debts. Equity is the difference between what you own and what you owe. It's your net worth. If your assets total $200,000 and your liabilities are $150,000, your equity is $50,000. For a company, this represents the owner's or shareholder's stake in the business. The balance sheet always has to balance. The two sides of the equation must be equal. This isn't some accounting magic trick, it's just pure logic. Everything a company owns, all its assets, had to be paid for somehow. Either it was paid for with borrowed money, which is liabilities, or with the owner's own money, which is equity. But just like the income statement, the balance sheet is absolutely filled with artistic judgments. How do you put a value on something like a factory? Do you use what you paid for it 20 years ago, or what it would be worth if you sold it today? Generally accepted accounting principles, the rules that govern this whole world, say you have to use the historical cost, minus all the depreciation you've recorded over the years. This means the book value of a company's assets on its balance sheet is almost never what those assets would actually be worth in the real world. This brings us to the third and final document, the cash flow statement. If the income statement is full of estimates, and the balance sheet is a snapshot based on accounting rules, the cash flow statement is your reality check. It shows exactly how much actual cash flowed into and out of the company over a period. It's the least manipulated of the three statements, because it's pretty hard to fake the amount of money sitting in a bank account. The cash flow statement breaks down into three simple sections. First is cash from operating activities. This is the cash your main business actually generates. It starts with the net profit from your income statement. But then it makes a bunch of adjustments to turn that paper profit into real cash. For example, it adds back depreciation, because that was an expense that didn't actually involve spending any cash. And it subtracts money that's tied up in things like accounts receivable. This number is incredibly important. A healthy company absolutely must, over the long run, generate positive cash flow from its operations. Second is cash from investing activities. This shows the cash used to buy long-term assets, like new buildings or equipment. It also shows cash you received from selling old assets. Looking at this section tells you whether the company is investing in its future growth. A big negative number here isn't necessarily bad news. It could mean the company is making smart investments to expand. Third is cash from financing activities. This includes cash coming in from taking out new loans or from investors buying stock. It also shows cash going out to pay back loans or to pay dividends to shareholders. This section tells you how the company is being funded. Is it relying heavily on debt, or is it funded by its owners? Together, these three statements give you this amazing multi-dimensional view of a company's health. But let's be honest. Staring at pages and pages of numbers can be totally overwhelming. That's why financial experts use a powerful shortcut: ratios. Ratios are like a detective's magnifying glass. They don't give you any new information, but they reveal the relationships between numbers, and those relationships tell an incredibly rich story. A $10 million profit sounds fantastic, but is it really? Compared to what? A ratio gives you that crucial comparison. There are 4 main types of ratios you should know about. First, profitability ratios. These tell you how good a company is at actually making money. The net profit margin, which is net profit divided by revenue, shows how many cents of profit the company keeps for every dollar of sales. A 2% margin might be absolutely fantastic for a grocery store, while a 2% margin for a software company might signal disaster. Context is everything. Second, leverage ratios. These show how much a company relies on borrowed money. The debt-to-equity ratio, total liabilities divided by equity, is a huge favorite among bankers. A high ratio means the company has a lot of debt compared to what the owners have put in, which can be really risky. But some debt can actually be a good thing. It can leverage the owner's money to generate higher returns. Third, liquidity ratios. These answer one simple but critical question: can the company actually pay its bills? The current ratio, current assets divided by current liabilities, compares the assets that will turn into cash within a year to the liabilities that need to be paid within a year. If this ratio drops close to 1, it's a major warning sign that the company might face a cash crunch. Fourth, efficiency ratios. These measure how well a company uses what it has. This is where we find the ratio that caught Chainsaw Al Dunlap red-handed. Days sales outstanding measures the average number of days it takes for a customer to actually pay their bill. When Sunbeam's days sales outstanding suddenly shot up, it was a crystal clear signal that something was seriously wrong. Either customers weren't paying, or the company was booking sales that weren't really sales yet. Another key efficiency ratio is inventory turnover, which measures how quickly a company sells through its inventory. A company like Walmart is an absolute master at this, turning over their entire inventory many times a year, which is far more efficient than a competitor who lets products gather dust on shelves for months. Understanding these ratios is like learning to speak a new language, the language of business. And once you can speak it fluently, you can start to have real impact. This is where the book shifts from understanding numbers to actually using them. The concept at the heart of this is working capital management. Working capital is essentially the money you need for day-to-day operations. It's calculated as current assets minus current liabilities. But you can think of it as a continuous cycle. A company starts with cash, uses that cash to buy inventory, sells that inventory, which creates accounts receivable, and then collects the cash from those receivables to start the whole cycle over again. The magic is that every single manager in every single department can influence how fast this cycle spins. A salesperson who negotiates for faster payment terms speeds up the cycle. An engineer who designs products with fewer, more standardized parts reduces the amount of cash trapped in inventory. A customer service representative who quickly resolves an issue makes sure the customer pays their bill right on time. This is the ultimate goal of financial intelligence. It's not about turning everyone into accountants. It's about creating a company where everyone, from the boss all the way down to the person on the factory floor, understands how their daily actions contribute to the financial health of the whole business. When people truly understand the numbers, they stop being just employees clocking in and out. They start becoming genuine business partners. Trust increases, office politics decrease, and better decisions get made at every single level. It transforms the workplace from a collection of individuals just doing their jobs into a cohesive team all playing to win the same game. So what's the great, enduring lesson from financial intelligence? For me, it boils down to a single powerful shift in how you see things. Before reading this book, it's easy to see a business as this mysterious black box. Decisions get made by executives in faraway boardrooms, and the reasons are often a total mystery. A new policy rolls out, a budget gets slashed, a project gets approved, and those of us on the ground are left scratching our heads wondering, why? This book hands you the key to that black box. It reveals that the logic of business, the why behind so many decisions, is written in the language of finance. And once you learn to read that language, you're no longer just a passenger along for the ride. You become a navigator. The most profound insight is this simple but revolutionary idea. Profit is an opinion, but cash is a fact. We're all conditioned from day one to chase profit. It's the headline number, the one that gets all the attention and glory. But Berman and Knight gently pull back the curtain and show us that a company can look wildly profitable on paper and yet be just a few weeks away from shutting its doors forever, because it has no actual cash. Understanding this difference is like being given a secret decoder ring. Suddenly you can see why your company might be holding off on new hires, even after announcing a record quarter, or why the finance department is suddenly obsessed with collecting money from customers faster. It's not random or arbitrary, it's about survival and genuine financial health. What I find most empowering about this book is how it democratizes this knowledge. It argues passionately that financial intelligence isn't just for the chief financial officer sitting in the executive suite. It's for the sales manager trying to structure a smart deal, the engineer choosing which component to use, the marketing lead planning next quarter's campaign, and the HR professional designing a new compensation plan. Every single decision has a financial consequence, and when we truly understand that, we can make smarter, more aligned choices. We stop thinking in narrow silos, saying that's a finance problem, and we start thinking like owners. So how can you start applying this today in simple, practical ways? Here are a few ideas to get you started. First, the next time your company announces its quarterly results, listen with new ears. Don't just listen for the headline about profit or earnings per share. Listen carefully for any mention of cash flow. Did operating cash flow go up or down? What did the company say about its cash position? This one small shift in focus will give you a much truer picture of your company's actual health. Second, try asking one simple question at work. You could ask your manager, "What's our team's biggest impact on the company's cash conversion cycle?" This question alone signals you're thinking at a completely different level. It might spark a great conversation about reducing inventory, speeding up how fast projects get completed, or improving how quickly customers get invoiced. It opens the door for you to become a real problem solver, not just someone who completes tasks. And third, apply these same lenses to your own life. You have a personal income statement, your paycheck minus your expenses. You have a personal balance sheet, what you own minus what you owe. And you have a personal cash flow statement. The actual money moving in and out of your bank account. Are you profitable but cash poor? Are you using what you own efficiently? Looking at your own finances through this lens isn't just an academic exercise. It's a powerful tool for building your own financial security and future. That was a summary of Financial Intelligence by Karen Berman and Joe Knight. We've touched on the major themes today, but a summary is like looking at a map of a beautiful city. The map is definitely useful. It shows you the basic layout and the major landmarks, but it can never replace the experience of actually walking those streets yourself, getting lost in the side alleys, discovering hidden cafes. The real value of this book is in the detailed stories, the rich examples, and the way it builds these concepts brick by brick until you feel genuine confidence in a subject that once seemed totally intimidating. If anything we've talked about today has sparked your curiosity, I really encourage you to pick up a copy. Reading it isn't just about learning formulas and ratios. It's about gaining a completely new, more powerful way of seeing the entire world of business. You'll find a link to the book in the description below. Also, if you found this journey valuable, please show your support by liking this summary and subscribing to the channel. That way you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Let's keep learning and growing together.